You will understand how a single hidden score controls your access to credit, interest rates, and debt cycles, and why you can't fully see or control it. A single late payment. Your credit score drops 100 points overnight. Same person, same income, same job. But now, the interest rate on that car loan just jumped from 8% to 28%. That's $12,000 more in interest on the exact same $20,000 loan. The algorithm that decided this. You can't see it. The exact formula. Trade secret. The appeals process. Good luck. 3 credit bureaus control the data. One company, FICO, controls the score. And you're just trying to figure out why checking your credit card balance the wrong way tanked your financial future. This isn't a warning about the future. This is the system right now. And it's designed to keep you paying. For over 30 years, a 3-digit number between 300 and 850 has controlled whether you get approved for a loan, what interest rate you pay, and whether you can escape debt or get buried in it. But the score itself is deliberately opaque. The exact algorithm. Secret. The bureau data. Error-prone. The impact of each financial decision. Unpredictable. In the next 15 minutes, you're going to see exactly how this opacity traps millions of people in debt cycles that cost thousands of dollars in extra interest, and why the system is designed to keep it that way. Let's start with what you're supposed to believe. Credit scores exist to measure your trustworthiness as a borrower. If you pay your bills on time, keep your balances low, and manage credit responsibly, your score goes up. If you miss payments or max out your cards, your score goes down. Simple, right? Except it's not simple at all. The FICO score, the one used by 90% of lenders in the US, is calculated using 5 main factors: payment history, 35%, amounts owed, 30%, length of credit history, 15%, new credit, 10%, and credit mix, 10%. But here's the problem: those are just categories. The exact formula within each category. Trade secret. Proprietary algorithm. Black box. You know payment history matters most, but you don't know exactly how much a single late payment will hurt you. You know credit utilization matters, but you don't know the exact threshold where your score starts dropping. 30% utilization. 29%. 25%. Nobody tells you, because FICO doesn't publish the specifics. And it gets worse. There are multiple FICO scores. FICO 8, FICO 9, FICO 10. Each one weighs factors slightly differently. Auto lenders might use FICO Auto Score 8. Mortgage lenders might use FICO 5. Credit card companies might use FICO 8 or Vantage Score 3. So when you check your credit score on a free app, that might not even be the score your lender is using. Credit Karma, for example, shows you your Vantage score, not your FICO score. Vantage score uses a different algorithm. Different weightings, different sensitivity to utilization and payment timing. So you could be monitoring the wrong number entirely. But let's say you're checking the right score. Let's say you understand the 5 factors. Let's say you're doing everything right. You still don't control the data. The score is based on information reported to 3 private credit bureaus: Equifax, Experian, and TransUnion. These companies collect data from your creditors, banks, credit card companies, auto lenders, collection agencies. But the data isn't always accurate. The Federal Trade Commission doesn't publish annual error rate statistics for 2023 or 2024 in the sources provided. But consumer complaints about credit report errors are common enough that the Fair Credit Reporting Act exists specifically to let you dispute inaccuracies. Here's the catch: disputing an error can take 30 to 45 days, sometimes longer. And during that time, if you're applying for a loan or a mortgage, that error could cost you thousands in higher interest rates or get you denied entirely. One source describes a single mom who lost a 6-figure job after alleged background check errors. Background checks often pull credit reports. If the data is wrong, the consequences are real. and you have no way to know if your report has an error unless you check it yourself. Most Americans don't check regularly, so the score is based on secret formulas applied to data you don't control, reported by creditors who sometimes get it wrong, and stored by bureaus who have no financial incentive to make the system transparent. But the real trap isn't just the opacity. It's how that opacity is weaponized to maximize lender profit. Let's talk about interest rate tiering. Your credit score doesn't just determine whether you get approved for a loan. It determines your interest rate. And lenders divide borrowers into tiers: prime, near prime, subprime, based on score brackets. The difference between a 670 score and a 740 score might seem small. Just 70 points. But on a $20,000 car loan over 5 years, that difference can mean paying 18% interest instead of 6%. That's thousands of dollars in extra interest. Money that doesn't go toward the principal. Money that just disappears into the lender's revenue. And here's the twist. The thresholds for those tiers are set by the lenders, not by FICO. One lender might consider 680 good. Another might require 700. There's no universal standard. No published table that says this score gets this rate. You walk into a dealership or apply for a credit card, and the rate you're offered is determined by an internal risk model you can't see, applied to a credit score you can't fully control, based on data that might have errors you don't know about. It's a negotiation where the other side has all the information, and you have none. Now let's talk about credit utilization. This is the ratio of your credit card balance to your credit limit. If you have a $5,000 limit and you're carrying a $1,500 balance, that's 30% utilization. The common advice is to keep utilization below 30%. But some sources suggest that even 29% might start hurting your score. Others say 10% is the real threshold for excellent scores. Nobody knows for sure, because the exact formula is secret. But here's the real problem. Utilization is calculated at the time your creditor reports your balance to the bureaus. And most creditors report once a month, on your statement closing date, not your payment due date. So even if you pay your balance in full every month, if you're using your card heavily and your balance is high on the day your statement closes, your utilization might look terrible. Your score drops, not because you're irresponsible, not because you missed a payment, but because of timing. And if your score drops right before you apply for a loan, too bad. That higher interest rate is locked in. This is how the system creates traps. You don't know the exact rules. You don't get real-time feedback. And by the time you realize something hurt your score, it's already too late. But it gets darker. Let's talk about minimum payments. Credit card companies are required to show you a minimum payment on your statement, usually around 2–3% of your balance. Paying that minimum keeps your account in good standing. No late fees. No missed payment reported to the bureaus. Sounds reasonable. But if you only pay the minimum, you stay in debt for decades. Let's say you have $5,000 in credit card debt at 22% APR. If you only make the minimum payment each month, it could take 15 years or more to pay off that balance. And you'd pay over $7,000 in interest alone. The sources mention minimum payment debt payoff time calculators, but don't provide specific numbers for this example. Still, the math is brutal. The minimum payment is designed to keep you borrowing. And the credit card company makes money on that interest every single month. This isn't a bug. It's the business model. Lenders don't make money when you pay off your debt quickly. They make money when you carry a balance, pay interest, and stay in the system. And the credit score system, with all its opacity and unpredictability, makes it harder to escape. Because if your score is low, you get higher interest rates. Higher interest means higher monthly payments. Higher payments mean you're more likely to only pay the minimum. And paying the minimum keeps your utilization high, which keeps your score low. It's a cycle, and the system is designed to keep you in it. So what are the stakes? For millions of Americans, credit score opacity doesn't just cost money. It limits access to housing, jobs, and financial stability. Landlords check credit scores before approving rental applications, Employers check credit reports before making job offers, especially for roles in finance or management. Insurance companies use credit-based insurance scores to set premiums. One bad score or one error on your credit report can lock you out of opportunities you don't even know you're being denied. But the real consequence is the debt trap. High interest rates mean you pay more each month. More each month means less money for savings, emergencies, or building wealth. Less savings means you're more vulnerable to unexpected expenses. And when an emergency hits, medical bill, car repair, layoff, you're more likely to miss a payment. Which drops your score, which raises your rates, which makes it harder to pay, which increases the chance of another missed payment. The cycle repeats, and the opacity makes it almost impossible to break out. Because you don't know which actions will help your score most. You don't know if your credit report has errors. You don't know if the score you're checking is even the one your next lender will use. Let's talk about subprime lending. Subprime auto lending, for example, targets borrowers with low credit scores, often below 620. These loans come with interest rates of 15%, 20%, sometimes 25% or higher. The sources mention subprime auto lending interest rates by credit score, but don't provide a specific table. Still, the pattern is clear. If your score is low, you're a target for high-interest loans. And here's the predatory part. Some lenders actually prefer subprime borrowers, because those borrowers pay more interest. They're more profitable, so the system isn't just indifferent to your debt. In some cases, it's optimized to keep you there. But let's step back. Why is the FICO algorithm secret in the first place? The official reason is to prevent gaming. If everyone knew the exact formula, the logic goes, people would manipulate their scores in ways that don't reflect true creditworthiness. But there's another reason. Opacity protects lenders. If consumers fully understood how their scores were calculated, they'd optimize aggressively. They'd time their payments perfectly. They'd manage utilization down to the decimal. They'd dispute every error immediately. And that would reduce lender profit. Because lenders make money on uncertainty, on mistakes, on borrowers who don't know the rules and end up paying more. The credit bureaus Equifax, Experian, TransUnion have faced lawsuits and settlements over data accuracy. But the fundamental system hasn't changed. The algorithm is still secret. The data is still prone to errors. And consumers are still operating in the dark. So here's the question nobody wants to answer. Is your credit score designed to measure your trustworthiness? Or is it designed to maximize how much interest lenders can extract from you before you stop borrowing? Because those are two very different goals. And the opacity makes it impossible to tell the difference. 3 things to take from this. 1. The score isn't neutral asterisk. It's a profit optimization tool disguised as a risk measurement, and the secrecy serves the lenders, not you. 2. Check your credit reports for errors immediately asterisk. You can get free reports from all 3 bureaus, and disputing errors is the only way to fix data you can't control. 3. Understand utilization and payment timing ruthlessly. Even if the exact formula is secret, keeping utilization under 10% and paying before your statement closes can protect your score from unpredictable drops. If you want more investigations into the financial systems designed to keep you paying, subscribe. Tomorrow, we're breaking down the hidden fees in the banking system that cost Americans billions every year. The industry calls them service charges. We're calling them something else. Stay curious.